Welcome back to the Real Estate Blueprint Podcast. I'm your co-host, John Soto. John does real estate, everything mortgages with my co-host, Austin Smith, more than an agent. How you feeling today?
I'm feeling amazing today. At the time of this recording, the Knicks season starts tonight.
Yes.
So I'm feeling absolutely amazing. It's a good Tuesday.
Good. Awesome. Make sure everyone to like, share, comment, subscribe. But we could keep doing this today. Today we have a special guest, CPA legend, a Newark native. I think we could say a Newark native now because you've been in Newark for some time, but I'll let you discuss that. We have Andrew Coombs today on the guest show today.
Thank you for having me.
Of course. Andrew, talk to us a little bit about yourself, your background, what you do.
Sure.
Let's kick it off.
Sure. So my name's Andrew Coombs. I own a CPA accounting firm. We do business taxes, individual taxes. We do audits. So nonprofits over $500,000 in New Jersey all need to have an audit. We do something called CFO outsource. Okay. So for accounting departments that want, like for companies that want to outsource their whole accounting department, we do that. We do something called R&D credit consultation. So companies that are dealing with the R&D credit, we do the tax portion of that. We just do everything related to accounting,
Awesome. Sounds like in the more bigger corporation side, do you do stuff for the small folks? Startups?
Yeah, we do individuals, we do businesses, we do it all. So
awesome.
Yeah.
So where are you originally from, and where's your business located now?
So I'm originally from.
Yeah, just twist it.
Twist it like that.
Yeah. Turn it to you.
Oh, sorry.
Right there.
There we go.
So I'm originally from Boston, Massachusetts.
Oh,
yeah,
Boston.
That's when you said the Knicks. I think we played them tonight.
We played Boston tonight, ironically. Are you a Celtics fan?
Big time.
Rightfully so. Man. I don't even blame you. Okay.
I went the last 2 years to the season opener in New York.
Yeah.
Yeah, but Knicks don't have a chance.
I listen. Shout out to the Celtics on the last chip, without a doubt. Man.
So well deserved.
Of course. So it's a worthy opponent essentially. Right. So we hope to see when it comes time to make it count. So, yes. No, shout out to the Celtics.
Yeah, but So I'm originally from Boston, and I grew up out there. I did my undergrad in Chicago. And then I came back to Boston to work at Deloitte, the accounting firm.
Okay.
And how I ended up in the New Jersey area, or New York, New Jersey, I took a job maybe about 5 or 6 years after public accounting, a private equity firm in Connecticut. And I was living in Harlem. Okay. And then I took a job at a large medical device company doing accounting and financial reporting and taxes in Franklin Lakes, New Jersey. And then that's when I moved from Harlem to Jersey City. Okay.
Natural progression, actually.
Right.
And then to Newark. And then
what's interesting is that I was telling him I didn't know what Newark was maybe about 10, 15 years ago. Right. The first time I heard of Newark was I was watching the Bill Maher show, and I think Cory Booker went on, and he was on there all the time, so he was talking about it. But when I thought of Newark, I just thought of airport. I didn't think of anything else besides that.
Right.
But what happened was how I ended up in Newark is when I wanted to start my firm, I originally wanted it to be in Harlem, but the startup cost was too high.
And what specific startup costs? Like what did those,
Rent, lease, you need a meetup space.
Gotcha.
Maybe not as much as it used to be, but back before COVID, like everyone was coming and everybody was doing, people were more face to face.
Yeah. Right. Yeah. Now it's a little more virtual.
Right. Exactly. So I went, Harlem was too high. Okay. The next best thing was Jersey City. Jersey City was too high. I was looking online and I saw a building on Bergen Street for $255.
That's the 4-family owned, right?
That's the 4-family, yeah.
$255.
And it was commercial residential.
Beautiful.
So I said, this is close enough to New York. It's close to Jersey City. It's in the middle of things. It's just on Bergen Street, but the rents of the apartments could pay off the commercial. So what I did is basically I decided to purchase that and the rents basically paid my rent and lease. So that's how I ended up in Newark.
What type of financing did you use?
I use FHA because I lived. I don't know if you did that one.
No, I didn't.
You did the next one. You did the one after that. Yeah. But I actually lived in one of them, and then the other ones were rented, but it still covered the mortgage. And then I bought another one down the street, which is bigger, and then bought a single family in the area, and I just been there ever since.
And how did you buy the second property?
The second one was commercial. That was that was like 25%.
Okay.
And I think the home was like, I don't know if that was
we did conventional.
I think it was conventional for that too.
Okay.
But yeah, I since then I've just been in Newark.
Just found a random property, good price. Let's go with it.
Yeah.
You happy about the decision?
I am, and I feel like Newark has a bad rap.
Mm-hmm.
But if you mind your business, they leave you alone. It's really not as bad as they say it is. From what I see.
100%.
No, I totally agree.
Mm-hmm.
It's an interesting time now because at the time of this recording, it's October, and usually I'll go. This is kind of fourth quarter tax prep planning for next year and what your plans are, and hey, here's what I'm looking to do over the course of the next year or two. How does that affect taxes? Let's start before we get into kind of more of the meat here. Pause. The tax season, which is pretty much right around the corner. What's one thing, and I know you service commercial before, our listeners will keep it individuals, W-2 employees, as well as real estate professionals and investors, right? Mm-hmm. What's kind of one thing that you want people to focus on going into this particular tax season, assuming that, with your expertise, tax laws are always changing with the election that's coming up and the consequences of, whoever's voting, how that changes the tax structure. But what's one thing that you want to lead with for people to keep in mind for this upcoming tax season?
Well, if someone doesn't have a multifamily property or a business, the tax law is very small. There's only so much you can do. So if they don't have any of those, they want to make sure that they're withholding properly. Okay, so a lot of times you hear people say, "Oh, I'm getting a big refund. Oh, I'm getting a refund." Refund is really your money.
Your money.
Mm-hmm. The refund, waiting for a refund is really I don't know. I just feel like it's a very poor man's mindset. It's like you really want to just break even, and you just want to try to offset, taxable liability with legal expenses as much as possible. If you have a business or multifamily property, that's a whole different animal because now the tax law is like this, right? So things that people should be doing is if they have a small business, like a single member LLC, they should have a separate business bank account. They should be paying estimates. And estimated payments are basically, payments paid into the IRS for money that you're making throughout the year so that you're not slapped with the penalty the next year. Because when you work at a W-2, they pay it all for you, right? And a certain amount has to be paid in by December 31st. So a lot of people say, "Hey, Andrew, why can't I just wait until April just to make a payment instead of paying estimates?" You don't want to do that because you get assessed for something called a 2210 penalty. That's why you make estimated payments. So for small business owners, you want to do estimates, have separate business bank accounts, tax planning. And then for multifamily property owners, you want to, I tell people that you should, if you can, because some mortgages have clauses, as you know, against it. But if you can, have a separate business bank account for each property. So in terms of organization, so from a high level, that's what I would say.
And for the penalty, the 2210?
Yeah, 2210.
How much is it?
It's a calc, but it's usually about 10%.
Interesting. So if you wait till your filing date, you're paying 10% more than what you would have paid if it would have been estimated payments.
Yes. That's the only reason why you pay it. Because everyone would say, "Hey, we'll just pay in April."
Right.
Yeah. And if you wait till October,
Yeah.
it's even more. Is it another penalty on top
Oh
of
yeah,
it?
yeah. The longer you wait after the deadline, it accrues interest. But you're saying in terms of October, in terms of like
15th.
oh
the
yeah,
15th
yeah.
deadline.
I see. Like the extension.
Yeah.
Yeah, it accrues interest.
Gotcha.
Yeah. So that's exactly what it is.
The the primary residence versus the investment property owners, usually somebody might choose to write off a home office in like their primary residence. Are there any other major tax benefits to owning a single family, like write-off wise, or is it, if you're going to use real estate as the vehicle for tax shelter, it should strictly be in multifamily?
No, not necessarily. So I mean, for single family, mortgage interest you could write off. You could also write off property taxes, and then in New Jersey you get a property tax deduction. So yeah, I mean,
Is that
there's
the anchor? Or
well, that's
different?
the anchor is different. The anchor is basically giving you like, if you're below a certain threshold, they give you like a payment.
Gotcha.
But the property tax deduction is different. It's something that goes on the NJ 1040. So there's benefits in owning a single family.
But it's limited.
It's limited. It's more with the multifamily, and it's even more with the business. Now, I will say one thing with the business, and this is important for everybody to know. There's something called the hobby rules. You know what that is?
What is it called?
Hobby rules.
No.
So your business, if you're claiming losses every single year, that's not good. Right? This is after year 3. They assess it every 5 years, but after year 3, if you have another loss, they consider it a hobby. You could only write off to the extent of the money you bring in. So if you brought $0, you could write off 0.
Gotcha.
So at year 3, your business should be showing income.
How about if you have $1 income? Would that offset?
Yeah, good with dollars
Profit.
income, yeah. But you gotta, some people they have a business and they claim losses every year, and then they get a letter 2 years later calling the hobby, and they reverse it and they get a bill.
Interesting. Does it have to be an LLC, or can they do? Because I know some people write off without even having an LLC.
Great question.
Yeah. Well, if it's a sole prop, yeah, they'll trigger it.
Oh.
But in theory, to kind of piggyback off of it or triggering it, but even as a sole prop, you're still available to have the same access to the same write-offs as if you were under an LLC. So, for example, somebody that's doing hair and they're accepting their payments and income, everything through Cash App.
Yeah.
Do they have to have an established LLC, or does sole props get these same benefits that they would if they were to have that revenue coming in under an LLC?
It does. It gets the same benefits, but the LLC protects you from personal liability.
Gotcha.
Correct.
That's the main difference.
I got you.
But that Schedule C form for sole props and single member LLC is the most audited form. So they have an algorithm. The more expenses you put in it, the more it triggers audit. So you want to make sure your stuff is very tight in terms of documentation when dealing with a Schedule C.
Okay. And another question. Lifestyle expenses, for example, real estate professionals or people in entertainment, or there's I don't want to call it a loophole because it's kind of a gray area, but shed some light on it where the independent contractor are doing lifestyle expenses and quoting them as necessary expenses for the business, whether that's just eating out or whether that's hey, for grooming, right? Like I've heard entertainers or whatever the case, that they'll use grooming as an taxable write-off. Shed some light on that.
Sure.
On can you do that just under any particular LLC? Do you have to have a specific career in order to do that? Talk about that.
No, that's a great question. It falls within the lines of the business that you're doing. So they're all gray area items. So, for example, if you're a real estate professional and you buy Gucci loafers.
Right.
That's
not a write-off.
Right. But,
how about if you're a luxury realtor?
No, I wouldn't.
Oh, that's a great question.
That's great.
That's actually a really good question.
It's a gray area, but I feel like the IRS agent, it depends who you're dealing with because it's gray area. I don't think that they would deem it as necessary.
Got it. Okay.
Necessary.
Right.
Definition is
Okay.
necessary.
Yes.
Not to keep the business running. Not to.
Right.
Okay.
But there are gray area items like that.
Right.
But you use your judgment. But if it's like, okay, business cards for a real estate agent, makes sense.
Of course.
Mileage for car, car expenses. Section 179, you could purchase a vehicle and take 80% off that if it's over 6,000 pounds.
Correct.
So there's things, but then there's gray area items where you say, hey, do I really want to go back and forth with an IRS agent about this?
No, I wouldn't.
So
Let's take a step back. What classifies a real estate professional, and what are the benefits in the IRS for that?
So a real estate professional is basically someone who works in real estate for most of the year. Okay. And basically,
any specific title, job title under real estate, mortgage professional, home inspector,
realtor, home inspector, could be mortgage, but maybe own some investment property.
Okay.
But with a real estate professional, you have to mostly be doing real estate.
Okay.
So, and what the real estate professional does, they don't have loss limitation. So basically, for example, like if you have $100,000, it's a real estate professional, that status, they get audited a lot.
Gotcha.
Yeah.
Because there's no loss limitation.
Right. There's no loss limitation.
I'm assuming there's
but
has to be something in the back end.
They get flagged a lot. But I tell people this, okay, if you're someone who's a realtor on the side, or does real estate on the side and then has a W-2 job working at the hospital, I want to do real estate professional. But if you are full-time doing real estate and you're not doing no W-2 and you're fully immersed in it, then you would take it.
I think one part of it is like for example, like when I go to my accountant and he's entering my information into the system, he has a kind of an audit alert essentially.
Yeah.
Right. So what are and it sounds like an easy question.
Sure. Yeah.
It sounds like an easy question, but considering the fact that I'm pretty sure you've been in positions or worked with clients that maybe have gotten audited or anything like that. What are the best practices just to stay away from that audit territory?
Sure. So your CPA should be able to tell you, like what we do is if I see a scheduled seat and has too many expenses, I say, hey, you really want to do all this? And do you have the documentation to support this? Because it's all about documentation.
Right.
If you have the documentation and it did occur, I mean, why not? You're good. But if you don't have the document, if you lost some paperwork, another thing I tell people this is for cars, right? For me, I do the standard mileage method.
I was going to ask you that. What do you prefer, mileage or payment or other?
I do the standard mileage method. And
what are the options?
I could explain to your listeners, which is, because real estate mileage is like really big. You're driving from place to place.
Yep.
But when you deduct car expenses, there's two ways you could do it. You could do the actual method, which is gas, tolls, car payments, repairs. That's the actual method. You're taking the actual expenses for the vehicle for the year. Or you could do, hey, I drove 12,000 miles, and they give you the expense, like it's like, 50-something cents on the mile, something like that. Something like that.
76 or 60-something?
It's like 60, 60-something now, yeah. Now, here's the difference. You might get more expenses using the actual method where you're taking gas, tolls, payments, or whatever. But your documentation has to be tight because you need to have your gas receipts. You need to have your toll receipts. You need to have your parking receipts.
Right.
When you do the standard mileage method,
kind of
all you need is a calendar that shows where you went in the mileage. They'll take that.
And
written down.
And you said it's 50 cents per mile?
I think it's 60 because of inflation.
60. I got you.
Yeah. It went up.
That makes sense.
It went up. Yeah, it's like
Jesus Christ.
Yeah, it went up.
That's how much of an impact. I got you.
Yeah.
Here's an interesting question. Not obviously not going into a particular political stance, but what are some of the things surrounding this particular election that have, some impact on where the tax code and tax structure and tax laws will be in the coming, let's just call it 4 years?
That's a good question. I mean, I'm independent. I'm just being purely objective here.
Mm-hmm. Yeah, no, yeah.
Understood.
It's just because you know why I said that, because I think Kamala had came out with the we wanted the tax on the capital gains, raise the tax rate on the capital gains, and like an article goes out and then everybody starts freaking out about or like the total population, not the particular population that it actually applies to. But the article comes out, especially with social media, and now everybody's like, oh, if you're flipping homes, you're going to be taxed now at a much higher, and it creates a false narrative. So it's just like, no, like, okay, here's what this candidate is saying, here's what this candidate is saying, but it just clears up like the facts, because while that is quote unquote true, that's also for people, I believe, at the highest tax bracket, if I'm not mistaken, right? So like, what are some, or even if there's some misconceptions that you want to kind of clear up so people just have an understanding, for this important decision?
Sure, yeah. So I just go back to when Trump did the tax reform before, and I'm being truly objective.
No, we're talking straight facts here.
I don't care about neither of them like that. What he did is limited the tax in terms of the Schedule A to $10,000 cap. Okay.
Schedule A is?
That's itemized deductions.
Okay.
Then there was the mortgage interest. He limited it to the $750,000. Okay. But he caused a lot of limitations on the Schedule A that people took. But what he said is, okay, I'm going to remove a lot of this stuff from the Schedule A, but I'm going to lower the tax rate. But I'm going to revert it back to the old tax rate in 2026. For the corporations, he lowered their tax rate, but it does not revert back in 2026. It stays like that forever until it changes again. So what's going to happen is a lot of those deductions that people took, like people don't itemize as much as they used to because of everything that was taken away. So in my opinion, that was not good for the individual tax. Like it was really bad for people.
And for the people listening, your itemized deductions.
Mortgage interest, he put a limit in terms of $750,000 on the principal. Okay, people were like doing mortgage interest for like 1.5, 1.
Right. And then can't write that off.
Well, it caps at 750.
Oh, it caps at 750.
And then
taxes too.
The 10,000
taxes are capped too. If I'm not mistaken,
state and local, the taxes you pay to the state, it capped at 10. It wasn't like that before. Yeah. But he said, I'm going to remove this stuff. There's a bunch of other stuff removed, but I'm going to lower the tax rate. Right. But it reverts back, and when it reverts back, you don't get that stuff back. So from that perspective, for short term, it's like you break even, but long term is not good. Okay. In terms of the two candidates, if Kamala wins, I predict that she will have more regulation. I feel like she's going to do something with unrealized, but for wealthy.
Okay.
Like people in the 9-figure range, so they could sell some stuff off. So I see I see that her doing something like that. I see increased regulation, probably increased audits. And regulation can sometimes be good and sometimes it could be bad. Too much of it's like
right.
And too little of it, then you have the financial crisis. Yeah, you have the financial crisis in 08 where they're giving loans to everybody.
Right.
If Trump wins, I'm just allegedly, I don't think he likes the IRS. He might drastically change how things are done. But who knows? He might keep things the same.
Right.
But I just see if Kamala was to win more regulation, if Trump was to win less regulation, but hopefully there's a middle ground, because too much regulation is not good. You can't really, it's harder to conduct business. Too little, people start doing, stuff that could create a bigger issue.
Yeah, that makes sense. Do you, is there, aside from like the presidential candidates' plans tax-wise, do you, because we're all trying to figure out where this next crash is coming from. We're all trying to figure out where this next, just kind of a reset or just massive cool down of the market, which is naturally supposed to happen in the normal business cycle for any particular asset class. And real estate has just not seen its decline. Is there anything tax-wise or tax structure-wise that can lead to a crash or has led to a crash or reset in prices in the past?
Well, that's a good question. This is what I think's going on. I believe we're in a silent recession. Okay? Just because you see the Dow Jones going up does not mean that Americans are doing well. Okay? The thing that's going on with real estate is private equity and corporations are buying all the homes, which is messing up the pricing of the market. So most of these homes that are going for sale are being bought by corporations. I think there was an article in Newark. I'm not sure if you saw it, where it was like 60%.
Yeah, it was insane.
It's insane. So do I see a crash happening? No, because there's not a lot of inventory. Only way I see it changing is if the White House has a regulation, which I believe the Dems are kind of potentially pushing against corporate housing. You could see it like they've been rumbling about it, but a lot of these people got hands in their pockets, so that's a tough monster to fight. But that's the problem. Like, so is it gonna crash? No, because capitalism, people become more and more greedy. Okay, I can't get this. Oh, I'm going to buy all the houses. Corporations got deep pockets. They're literally buying up every house.
Yeah, like you said, the Dow's increasing. I think we're just seeing a wider spread of the wealth gap.
I feel like we're in a recession. It's just they're not calling it that.
Right.
But my prediction is this. This is what's going to happen. The corporations can only buy so many homes until eventually they have to dump them. They eventually have to, private equity firm.
And that dump is the correction?
That dump is the correction.
Why do you have to sell?
Okay, so if you have a private equity firm and they have funds, the funds have a life. And LPs invest into the fund. So if it has a 5 to 7 year life, they have to eventually sell.
And get the return.
And it's starting to happen a little bit in Florida now. Florida's, the prices are actually going down. They're actually doing dumps. They're doing dump sales. That's what's going to happen.
Can they just refinance?
Well, that's a good question. But the thing is, okay, if they refinance, they give the investors back their money. They could, but then they have a sitting asset that they have to pay a mortgage on.
Yeah. And not to mention, most of the the corporate entities that are buying aren't necessarily buying like with a straight investor mind, where let me buy it, fix it up, rehab, so on and so forth. I find that mainly still like us that are in the trenches actually doing the rehab process and so on and so forth. I feel like they are buying a little bit more in a hedging manner and as a long-term hold that's better than some of the even more safer asset classes that are out there. So I think they're just buying it at retail or higher than retail, and then the market just keeps going on for there. But by the time that they probably do get equity, 5 to 7 year term is a very long time. So there can be some equity in there. But
and as you mentioned, the regulations passed about the unrealized, they're definitely gonna have to.
Oh yeah, they definitely will. That's why I feel like they're trying to push that. To try to kind of, because
that would be the correction.
That would be the correction.
Because that made me ask that question was when you were talking about Commons Plan. Not saying one is better than the other or whatever the case, but it's a thought process that and it makes sense though.
It does.
Off the unrealized gain, only because that's equity 101, just unrecognized gain, right? Yeah. Whereas in real estate, and I do know that there's some opportunities on it with stocks and so on and so forth, but obviously they give you the opportunity to tap into that equity, and now you're doing so without having to pay any taxes, so Uncle Sam doesn't get any money out of it, right?
Loans and stuff, right?
So, you know, some of the models is like, yo, refi till you die and just keep taking that money out, which these individuals, these, you know, these billionaires, extremely wealthy people, they're just using their unrealized gain to either get a loan out or some form of cash, which you're not paying taxes on, and you're doing this by the millions.
Oh, yeah.
So the government, you know, obviously, so when you mention, like, I can see any particular president as far as, yo, we're missing out on a lot of money that can be coming in.
Oh, yeah.
And forcing some type of regulation or some type of yearly unrecognized gain tax or whatever the case to start to reclaim some of that. So if that starts to happen, people start selling off their shares, you know, that causes, you know, the market to drop essentially, at least like as far as like stock market in that particular analogy. And that can, you know, that can have a tidal wave and that can have a ripple effect. So that's what made me ask that question, because I think it's you know, we're kind of trying to figure out where this next one's coming from and what's going to be the, because I do believe this, and kind of to your point, I do think that we're in some form of silent recession or something that they do not want us to know about, simply because they did not want to go through it when COVID happened, which is why they dumped all the money in the markets anyway. So I'm interested to see what's gonna. I feel like it's on a hairpin trigger right now, and there's gonna be one rule, regulation, change, and then it's gonna set everything like kind of in motion. You know what I mean? And it's the domino effect that really takes us down. But it's interesting to see where that, you know, can potentially come from. And that was a very interesting. I can see that causing something like that. So that's interesting on that, like how tax policies like can have an impact on that.
But for real estate, so if they force them to sell the unrealized gain to do the actual, to gain tax of it, they could just avoid it with a 1031, correct?
They could do a 1031, but the laws haven't been put into place for the unrealized yet.
Okay.
It's not set in stone, but it's something that's proposed.
Got it.
For people making 9 figures, which is what, the 0.0000. It's trying to stop hoarding.
Gotcha.
Which is, if the wealth gap gets big enough, people are gonna start cannibalizing each other. Like they're literally gonna start.
True.
It's like gonna be like it's gonna be serious.
No, I can imagine.
You know,
I can definitely
they don't want
imagine.
that. Yeah.
That so talk to us. Run for the people that are listening. 1031 exchange. Some people know, you know, because you have your what's it called, deduction, where you're able to take off 250 primary residence. Right. 250 if you're single, 500 if you're married. Off the capital gains. Run us through 1031 for the investors and what that process looks like and why that's a good option for tax shelter. Sure.
So I mean, if you want to stay in the real estate game and stay in the owning rental properties, a 1038 is a great vehicle. So basically, you take the capital gains from a sale, and you have to find a property within 45 days and close within 180 days, and you fill out a form in a 1040, and you use that capital gains to purchase another property. You get away with basically not paying capital gains tax. You know, some people, they don't want to get back into real estate. They say, I'd rather pay the taxes, but it's a good, you know, tax, you know, strategy if you want to take the proceeds to maybe get something that nicer or better, or something that in a location you like more. There's also something called opportunity zone funds, where you put your money in an opportunity zone funds, which are basically funds in distressed communities like Patterson, Newark, Trenton, Camden. And you leave it in there. It's like a long time. It's like 10 years. Right? But basically, you pull it out after the 10 years, and you don't get hit with capital gains. Now,
do you earn any interest on that, or like any?
No, that's the thing. So
it's just a 10-year hold.
It just sits there.
And we'll wash your hands, and you don't owe anything.
Right. So it depends. It's like if there's a high inflation, you could lose out on it, or you could gain on it. It's the risk you want to take, but you just got to leave it in there. But yeah, so I mean, basically, a like-kind exchange. If you want to buy another property, you don't want to get hit with capital gains, and you could turn it around quickly. And I tell people, if you want to do a like-kind exchange, kind of have the property in mind that you want to buy before you do the sale.
Yeah. No, I've had a successful one. I've had a not successful one.
Yeah.
And just for like time wise and participating in two very different markets where, but the only key fundamental difference is I had the property that I was going to buy before I, wind up selling. With 1031, talk to us about DSTs.
Before you go into that, is there any other vehicle that has something similar to 1031, like stocks or anything else? Any other asset class?
Oh, that's a good question.
That's a good question. Yeah, stocks, you have capital gains could offset by capital loss, and you could roll forward capital losses with stocks. There's also something with stocks now. You have to do something called a 3115 adjustment. If you're a trader, you can use capital losses to offset ordinary income. It's highly auditable, though.
I can imagine.
And you have to do something called a 3115 adjustment.
And what constitutes you being a trader versus versus a stock investor?
You're doing it like full time. You have the series license.
Interesting. Is the series license is a absolute?
Well, you got to show proof that you serious about it. So I would get the series if you're doing it full time, because you got to show proof.
But you have to be full time. Is that what?
Yes, you can't. Yeah, you can't like. If you're gonna do that 3150
W2 income on the side.
Yeah.
Okay, so someone that's like just an entrepreneur, like say an individual is just an entrepreneur. He's sitting on a bunch of loads of cash, so he's not worried about paying bills on a month-to-month basis, and he's taking just a couple of, he's watching and reading the markets 24/7, weekends, articles, da da da.
Right.
But he only takes maybe 2 trades a week.
No. There's people who are doing this full time. Trading
but
every day.
He technically is doing, but does trading, is there a case for over trading? Hey, I thought these positions as far as my work were the 2 best positions. Do I need to over trade just to prove my point that I'm doing this full time?
It's a gray area, but if you're a full-time trader, you could do it. But if you're someone, like I said, if you're trading and then you're working at a hospital, W2, then no.
Got it.
You know what I'm saying?
Goes back to real estate professional.
Correct.
So, okay.
I wanted to bring one thing up too, because you brought it up before we met, the cost segregation thing.
Oh yes.
Oh yes,
that's a good one.
Okay, so I wanted to be very clear with the real estate. Okay. Depreciation is a temporary fix.
Okay. Yes.
It's important for real estate investors to know that.
Let's explain both.
Let's actually go into all of that,
and cost segregation.
Sure. So I'll start from the beginning and go through all of it. So depreciation is like you get a cut and you just put a Band-Aid on it, but it doesn't actually heal it.
Right.
Okay.
Right.
Okay. So I'll tell people how depreciation works. Basically, if you have you buy a residential property, you take the cost basis, strip out the land, these usually 10%, okay? But you take the cost basis divided by 27 and a half years, and you take that expense on your return for 27 and a half years. When you sell the property, there's something called depreciation add back. You have to add back that depreciation. It's the 47.97 is like when you sell an asset. You have to add it back. So it's like basically you're adding it to the sales price. It's a temporary fix, but you have to give all that back when you do the sale. Okay.
In taxes. So if you took off $25,000 over the course of X amount of years, so the property, you owe that $25,000.
You got to add it back. But when you do a sale of a property, there's ways to help offset the gain. You could increase your cost basis based upon the expenses related to improving the property and getting it ready for sale. So, John, if you bought a property for $150,000 and you put all this work into, you put new tiles, the cost basis might be $250,000, $300,000.
And that's over the time. Let's say 3
over
years.
The time, yeah.
Even if I already wrote off the expenses the previous
No,
years?
so that's double dipping.
Gotcha.
That's double dipping. Okay. But, if you already wrote it off, then no, because that's called double dipping. Okay. But I will tell you this. Okay, so that's depreciation, right? You also have cost segregation. Cost segregation is not for everybody.
Okay.
So it's like, if you have a
Who's it not for?
if you have a 2-unit building that's already getting losses with depreciation, regular depreciation, it's like there's no purpose because you have a loss limitation on your Schedule E, right? For cost segregation, that's for like
What's the limitation?
it's a calc. It's like
Oh, okay, it depends
on
on
AGI, yeah,
Gotcha.
but cost segregation is for like you own a 100-unit building, you purchase it for like 2-3 million,
Okay.
and that depreciation is just not gonna cover that rent.
Gotcha.
So it's like you're kind of like accelerating the depreciation to ease the burden. So you're segregating costs rapidly to help offset the income that's coming in.
And you're gonna do that for the first year, or how?
And I mean, until you use it up. Once you use up, the cost basis is done.
And that's when people sell normally.
That's what they usually sell. So you're basically accelerating the depreciation.
Gotcha.
Okay, so cost segregation, it might not be necessary. Like, you'll know better than anyone. Like, if you get net income every month and it's like 20,000, 30,000, 40,000 after you may want to do cost segregation.
Right.
Gotcha.
You know what I'm saying?
Okay.
But if it's like a 2-unit, unless it's in like Brooklyn and it's like making crazy money,
Gotcha.
you know, it's not always necessary.
And then with the cost segregation, it's kind of the same thing as well. Whenever you do sell, you owe that back.
to
And
add
just
it
for
back.
Oh, you still do have to add it back.
You have to add back depreciation whenever you take
How
it.
about cost segregation?
Well, that's technically depreciation.
it's just if you're doing a straight line or
Yeah,
cost
you're
segregation.
basically kind of like accelerating it.
Gotcha.
So, and just for clarification for anybody that's listening that maybe had this, when you say add back, right? So the 25,000 that you took off as far as a regular just depreciation, you sell the building. The add back, is that $25,000 tax, or that's $25,000 that you add to your cost basis?
No, you don't add to your cost basis.
So add to the cost basis.
It's
Okay.
added to basically you put it in a
profit,
line item.
right?
Yeah, it's added basically to your profit, to your sales.
Gotcha. But
So
in
instead
theory,
of
though,
150 in profits, 175.
But basically, it's washing.
Correct.
But long term, it's basically washing itself out because you took the expense.
I was about
already.
to say.
It's that's what I say. It's a temporary fix.
and you're still not paying $25,000 in tax. You're paying whatever that added to the
percentage.
cost of business,
Yes.
so on and so
Whatever your
forth.
bracket is.
So that
Yes.
number still might be $3,500, for example, essentially.
right.
Okay, gotcha.
Yeah.
Gotcha.
Yeah.
Gotcha. Okay. The what we were talking earlier, like businesses versus multifamily real estate. If someone is starting to take the next leap in their personal finances and they're looking at their options, routes, and they're like, okay, I can either go multifamily or I can either go with starting a business. Both produce cash flow, both have a equity component to it. Does one have more benefits than the other, going with a business versus going with just multifamily?
I would recommend doing both, but I would probably say the business has way more.
Okay.
Just the law. There's just so much you could do with the business.
Can you give us some examples, like where, like
Business, home office. You could do stuff like that.
Yeah. So it's just more itemized write-offs?
More write-offs, and then like for example, like for a business, this is like a tax loophole. Like if, let's say it's like March and you found out you owe like $20,000. If you have a business, you could put money from the business into a SEP IRA and get a direct deduction on your return.
Direct.
Yes,
Deduction.
right. So for example,
One
this
to
is a
one,
loophole.
that-
So if you have a business, right? Let's say John, you have a liability of like 20,000, right? Let's say you've taken every deduction that you could take. You could say, hey, and remember, this is the next year. You're doing your return in March. You could say, hey, I want to put money into a SEP, 20, 30,000 to a SEP, and you could take that deduction on your return on your schedule, if you have a single member, on the Schedule C for that year, even though the year passed.
Just
Okay.
by the
It's a loophole.
in the SEP.
Yeah, so a SEP. So if
So
you
instead
didn't,
of paying the IRS 20, you're paying yourself 20.
well, you pay, but when
Well,
you take, but when you take it
percentage.
out the SEP, you get taxed.
Gotcha.
So it's like, it grows with the market though.
Yeah.
You get what I'm saying?
So it's the perfect hedge.
So it grows with the
It's
market.
kind of like a 1031 if you
Yeah.
kind of right. Similar
Are you-
as because you're pushing the tax liability further out.
Well, you're putting it into a SEP.
Yeah.
Now there's risk because the market could go sour.
Right.
But if
Gotcha.
it goes well, you basically make out.
You're covering it.
Gotcha.
And you're covering it. Speaking of which, this would be great to kind of take us on our descent here. Give us your favorite tax loopholes.
Favorite tax loopholes is the
Because
SEP.
that one's a pretty good one.
That was one of them.
obviously.
The
That's a
SEP.
good one.
It's a really good one, actually.
Yeah, the
And
SEP.
you can only do that under the business.
Yes,
So if
under
you
the
How
take
about
the-
the business owns real estate? Can you do that?
you can. Yeah.
Okay.
Yeah.
But is it only the business portion of that like for a mixed use unit, and you have a multifamily with 3 units up top and a sneaker store at the bottom?
Mm-hmm.
Can you only take that based off of the sneaker stores?
Well, no. Well, if the business
Revenue?
like okay, and this is something important to know. Some people have homes. They say, "Oh, this home is owned under the business," and it's not really owned under the business. The deed of the home's into the person's personal name.
Right.
Unless the deed is in the business name, is not owned by the business.
Got it.
Okay. So let's say there's John Soto Consulting, and the deeds of his properties in that business, and he has a candy store in that business, and he could take the proceeds from that business if he has a liability issue and put it in a SEP and take that deduction.
So it's whatever that LLC essentially, or that sole
Yeah.
provider produced revenue wise,
And they have
or
they have to really be owned by the LLC. Because people do that. People do that, and it's like this home is actually not owned by the LLC.
right.
So why are you putting it on this form?
Way.
Yeah. So the SEP is
That's a pretty good one.
the SEP is a great loophole. S corps are a great loophole because
I wanted to ask between LLC
Yeah.
and S corp, but yeah, go ahead.
yeah, no, S corps are a great loophole because what it does is it eliminates self-employment tax.
And what is an S corp, by the way?
So S corp is called a small corporation, right? And
I never knew what the S and S corp meant.
yeah,
but
it's a small
I got
corporation.
you.
It's like limited to like 100 shareholders. It's like,
Okay,
but it's called a flow-through entity. So a flow-through entity means that the actual entity doesn't get taxed. The profits flow through you through a form called the K1, which flows to page 2 of your Schedule E.
So it's similar to LLC then.
Yes, it's a flow-through. LLC is flow-through.
Okay.
Now, C corps are double taxation. They're the worst for taxation. But you say, hey, why would someone want to be a C corp? Because to get institutional investors, if you're having a startup, they want you to be a C corp, or they're not going to invest in you. Okay. So an S corp is what we call flow-through structure. That's a good tax loophole because it eliminates self-employment taxes on your K1 when you do a distribution. When you have a Schedule C, a single member LLC, sole proprietorship, you get hit with self-employment taxes, which is like 10 to 14%. S corp eliminates that. Okay, so that's a really good loophole. To become an S corp, you have to file a form called, in New Jersey, it's a New Jersey 2553 and a federal 2553 to get the status. But that is my favorite entity structure in general.
Because S corp and LLC can do the same write-off. It's just the only difference is the self-employment tax.
Yes, you basically save
Gotcha.
10 to 14%.
Are you able to have an LLC and file as an S corp?
In New Jersey, it's a 2-step. Okay, so that's a very good question because there's these people say, oh, you could just file it. No, not in New Jersey.
Audit.
Nope.
Not in New Jersey.
You got to file a 2553 for the federal, and the state you got to file a 2553. So if it's a state where you only need it for the federal and you get automatic, cool.
Gotcha.
But some states is 2 steps. So at the federal level, you look like an S corp, and at the state level, you LLC,
Right.
and then now you're getting letters.
Gotcha.
And I see this happen all the time in New Jersey.
Audit.
Gotcha. Yeah. But so that's a good one.
That's actually
How
a
about
really
the
good
one?
one.
I don't know the.
What are the? Go ahead.
Yep.
The one where you rent your home to your business? What's
Yeah,
it
the
called?
Augusta rule.
Augusta
Yeah,
rule?
yeah.
Okay.
But
Is that good or is that?
That's okay.
But
I
you gotta
mean,
have the proper paperwork,
you have to have the
and the
paperwork.
meeting minutes and all that good stuff, right?
Yeah, you have to have the paperwork, but it's like it depends. If you might be at loss limitation, you might not need that.
And what's the Augusta rule?
It's basically you could like rent your home to yourself and claim an expense or something.
10
like
days to max, something like that?
It's like 10 or 14 or something like that. But yeah, it's not like, I don't find it particularly captivating, you know. But I think that the S corp is good too, because it's less likely to get audited. The percentage is like very low.
So interesting.
Very low. Like Schedule C's are very high, but S corp's like.
So why?
Let's change our minds to S corp.
Well, yeah, I mean, S corps. I would say
Yeah,
S
like, why
corps are
wouldn't
worth it. They're worth it because you don't get self-employment tax on the distribution.
Are there any are there any cons? Because I know
Is it like higher cost, or is it
the only cost is you have to pay that state fee, which is like, depending on the income, like it could be like $300 to $1,000 a year, but that's it. But you save more than that, you know, with the tax deductions.
And I because I think I was researching, and at some point with S corps, you have to put yourself like on payroll essentially, right? So that's where you start to, like, as an entity, you put yourself on payroll, and you know, it's one of those things. I think like I was researching where whatever you're getting paid has to be the market value of that position. So for example, as an agent, if, you know, I just was claiming, let's just call it 50,000, that the IRS has to see that amount as market value for said position. So it's basically to make sure that you're not hoarding all of the actual profits on the portion that doesn't get the self-employment tax.
Yeah, so it's like, they say like a comparable salary.
Like a comparable,
yeah,
you know, like
so
you couldn't be, and real estate agent is actually a terrible one, because that, not that the best example, but for a photographer, and they open up their own studio and they open up their own S corp, but then at the end of the year, the business made $100,000, but then they're claiming 10 as their salary, and that's the only amount that gets taxed. They're like, hey, what do you know what I mean?
Yeah,
you got to pay yourself a comparable salary, and in order to do that, you have to kind of have the cash flow coming in consistently and repetitively, so that way every 2 weeks or however you cut it, that you're not messing up the operating income or you know, what you need to actually run the business.
Right. Yeah, but yeah, it's got to be a comparable salary.
Something comparable.
Yeah, something comparable. But I like S corps. I think that they're really good.
I think it's a very good.
The best structures, in my opinion. But yeah, no, definitely there's going to be a lot of tax reform, a lot of changes. I see it. I see a massive reform change.
Doesn't matter who wins the election.
Doesn't matter who wins. I think that if Kamala wins, it's going to be kind of going after regulations and increasing it. I think if Trump wins, it's going to be stripping a lot of things.
It's both risky.
Yeah.
Is the tax system just completely broken? Or does it actually help more than it hurts? And are we just picking our poison? Or is the tax system truly, no matter how much you skin it, the can always just gets kicked further down the road, and then like it's truly just broken that keeps getting injections and
I think it helps. I also think if Trump wins, he might try to do a flat tax.
A flat tax.
I feel like I'm just guessing. I feel like he's really going to try to gut the IRS and the department.
Tax, what do you mean?
And
no matter what you make, everyone
he
pays
might
the
try
same?
to do that.
That would be.
And I think.
And is he doing that on a percentage, or is that
I think so. There's been rumblings. I don't know how true it is, but the department, the DOE.
So no tax brackets. One person get.
Just everybody gets 20%.
That's what I'm hearing. I feel like I'm not sure if that's true. I'm just saying it's just rumblings. It could be true. It could not be true. But I think it's going to be definitely some extreme stuff that could be coming.
I think they've all been waiting for it for after this election, and you know it's going to be very, very telling. So once this episode goes live, we'll as y'all are listening to the episode, be able, you know, look outside, check your surroundings, seeing if this episode had any bearing effect.
Yeah.
And listen, where can people find you at? Your services, your education. Where can people find you at?
Sure. Yeah. So they can find me at my website, www.cpacoombs.com. My Instagram, Coombs CPA, COOMBS CPA. My LinkedIn, Andrew, ANDREW, COOMBS. And the office number, 973-849-9119. Once again, that's 973-849-9119.
No, that's amazing. Listen, Andrew, we greatly appreciate you.
Yeah.
Obviously, tax-wise for you and the people and entities that you're serving is year-round. This is not something that just comes through right before April.
Yeah.
So, it'll be really interesting to see, especially just with how tax laws are now. And then come in a few weeks, how things will be different going into the next tax season and whatever you have to adjust. Greatly appreciate you taking the time to come out, to come give us some game, to come drop some gems that people, I hope, as well as us, just take and put into action, so that way we can take advantage of everything that the tax laws have to offer, while making sure that we follow the proper protocols and doing things correctly. So for everyone listening, please definitely reach out to Andrew, whatever questions that you have tax-wise. Don't assume that you know everything. Don't just read an article and take people's advice before you get audited out here. And be sure to like, comment, subscribe. Is there anything that you want to see on the show? Be sure to let us know. We're here to keep bringing this gold to you, so that way we can continue to tap in. Any last remarks here?
No, thank you guys for having me here. I appreciate it. I'm honored.
No, I love these types of episodes, and this is Austin, aka More Than an Agent, with my Dominicano hermano, John Soto, as the co-host. This is the Real Estate Blueprint Podcast, signing off.